Most people don't lose money because there's no opportunity. They lose it because they choose the wrong one. And just because an opportunity exists doesn't mean it's right for you. And today's problem isn't access, it's discernment, knowing what's worth your time, your money, and your future. And when we gather like this, especially as a Filipino community, this is bigger than business. It's connection, shared knowledge, and not building alone. So, for those who I haven't met yet, my name is Jenny, founder of Your Global Connection, born and raised in the Philippines. I came here to grow and build like many of you. And in real estate, here in Las Vegas, I saw one truth: opportunities are everywhere, but the right guidance and access are not. And that's why we created YGC to connect people to wealth, wisdom, and world class opportunities by bridging the US and the Philippines through relationships first. And this isn't just a network, it's an ecosystem. And before we continue, thank you to our sponsors and our partners who make all of this possible. We appreciate you all. Today is different. This isn't about what to buy, it's about how to decide if something is worth buying. Because this isn't about taking chances, it's about making smart, confident decisions with what you've already built. So let's get into it. Let me share what I see all the time. Even smart investors make decisions based on three things: following others, focusing on price, and entering too late. So let's talk about following others. You see people buying and feel like you should too, but you don't know what their full situation is. So you're not investing, you're just merely reacting. Number two, focusing on price. Is it cheap? Well, cheap doesn't mean valuable. Real estate is about demand, location, and long term use, not just price. And number three, entering too late. Waiting until it's popular feels safe, but by then you're already paying premium. So the best opportunities come before the story is obvious. Here's the truth: the biggest mistake isn't the market, it's about not having a framework. Without one, everything is confusing. Is it good or is it just marketed well? Is it early or is it too late? Is it right for me? With a system, you stop guessing and start evaluating. And that's what we're building today: clarity. Because once you have it, you don't chase opportunities, you recognize them. On the next slide, we'll talk about the framework that changes everything, and we call it the P.I.E.R model. Investing, especially in a different market, can feel overwhelming. Too much information, too many opinions, too many options. So we use one clear framework: the P.I.E.R: position, infrastructure, entry strategy, and regulation and risk. So you're going to ask yourself, is there real demand? Is it growth? Is growth supported? Does it fit your capital and your timeline? Are you protected? This isn't a concept, it's a filter we use every time, because not every opportunity is a good one, no matter how it looks or sounds. So don't ask, is this a good deal? Ask, does it pass the P.I.E.R? If it doesn't, it's a no. That's the power. It gives you clarity and confidence to walk away. Because most people don't lose money from lack of opportunity, they lose it by saying yes to the wrong ones. Investing isn't just about making money, it's about protecting and growing it strategically. So, next, we are going to break down each part of the PIER so you can think like a strategic investor and not a reactive one. So, let's start with the most important pillar: position. Where you invest matters more than what you buy. Most people focus on the unit, the design, the amenities, the price, but that's surface level. The real question is, Is there demand in this location? A great unit in a weak area will struggle versus a simple unit in a strong area that's definitely going to perform, because real estate isn't about looks, it's about use. Demand drives rent, occupancy, pricing, and resale. So don't ask, do I like it? Ask, do people need to be here? Where do they work? Is it convenient, connected? That's where demand is created. Smart investors focus more on position first. If position is strong, everything gets easier. If it's weak, everything gets harder. So, bottom line is, ask yourself, is there real demand here, or is this just good marketing? So, what creates demand? It comes down to three things: jobs, where people work; population movement, where people are going; and lifestyle, how people want to live. Jobs drive rental demand, buyer activity, and stability. Population growth creates new renters and buyers. And lifestyle, that provides convenience and access and quality of life, that drives choice and pricing. So, a simple breakdown: jobs equals need, population equals growth, and lifestyle equals preference. So when all three align, you have a strong position. People don't buy or rent based on the building, they do it based on their life. And when you see that, you stop chasing properties and you start spotting the real opportunities. So here's a simple filter to use every time. Pause and ask yourself, would someone live here? Would someone rent here? Would someone buy this from me later? Not, do I like it, but would someone else choose it for their life? So let's break that down. Would someone live here? Is it convenient, accessible, near jobs or essentials? Would someone rent here? Is there real demand from people in the area? The resale opportunity. Is there a clear next buyer? Because your next exit matters as much as your entry. If all three are clear, then that means there is real demand. If you hesitate, that means it should be a no. Smart investors don't win by saying yes more, they win by saying no strategically. So use this filter, it keeps you clear and more in control. Now, let's move into the second pillar: infrastructure. Infrastructure equals value, because if position tells you where demand is forming, infrastructure tells you how demand grows and how fast it grows. And this is where real estate starts to become very powerful, because value is not just created by the property, value is created by what's happening around the area, around a property. So I want you to remember this simple idea: infrastructure equals value, because infrastructure improves three key things: mobility, access, and growth. So let's break that down. First, mobility. How easily can people move? How fast can they get from home to work to their daily essentials? Because time matters. If you can reduce someone's commute and make their day more efficient, make their life easier, that location becomes more valuable. Second, access. What can people reach from this location? Are there nearby business districts, schools, hospitals, transportation hubs? Because access is what makes a location usable, and usable locations attract more people. Third, growth. What is being built here? What is improving? What is developing in the area? Because infrastructure is often a signal of future expansion. So when you see roads, railways, commercial development, and public investment, that usually means the area is expected to grow. Now, when you combine all of the three, better mobility, stronger access, and ongoing growth, you create something very powerful: increased demand. And this is the key connection I want you to understand. When people can move easier, live easier, and work easier, more people choose that location. And when more people choose that location, demand increases. And when demand increases, value follows. But let me add one important layer here, because this is where many investors get it wrong. Just because you hear about infrastructure doesn't automatically mean it is a good investment. You have to ask, is it actually being built? Will people truly use it? And does the price still make sense today? Because infrastructure creates opportunity, but only if you enter at the right time and in the right location. So as you move forward, I want you to start thinking differently. Don't just look at the property, look at what's happening around it. Because the investors who understand infrastructure are the ones who position themselves before the value becomes obvious. And that's where the real advantage is. So now let's bring this into a real world context, specifically in the Philippines, because everything we just talked about, position, infrastructure, is already happening in a very clear, powerful way. Right now, we're seeing this through major infrastructure corridors like the Metro Manila subway, the North South commuter railway, and the Clark corridor. And I want you to understand this clearly. These are not just projects, these are long term shifts in how people live, move, and make decisions. So let's break that down. The Metro Manila subway isn't just about transportation, it's about reducing travel time, improving daily efficiency, and connecting key parts of the city in a way that's not possible before. So areas that used to feel far will start to feel accessible. And when accessibility improves, demand follows. The north to south commuter railway, that's even bigger in scale, because now we're not just talking about Metro Manila, we're talking about connecting Metro Manila, Central Luzon, and areas moving further south. So, what does that do? It expands what people consider a livable distance. People can now live farther away, but still stay connected to jobs, business districts, and opportunities. And when that happens, entire new ideas become viable for real estate demand. Now, let's talk about the Clark Growth Corridor. This is one of the most important long term plays, because Clark is not just a growing infrastructure, it's growing from a combination of transport access, airport expansion, business and industrial activity, and government backed development. So, this is not just a single project, this is an ecosystem. An ecosystem created stronger, more suitable demand. So, when you look at these three together, subway, railway, Clark Corridor, you're not just looking at developments, you're looking at a shift in how people will live, how they commute, where they choose to live, how far they're willing to travel, and what they prioritize in their daily life. And this is where smart investors think differently. They don't wait until everything is finished, they don't wait until prices have gone up. They look at these corridors and ask, where will demand move next? Because infrastructure doesn't just change locations, it changes behavior. And when behavior changes, that's when the market moves. So when you're evaluating opportunities in the Philippines, I want you to start thinking in terms of corridors and not just properties, because the biggest opportunities are not always in the most obvious places today. They're in places that are becoming more connected, more accessible, and more livable over time. And that's where infrastructure turns into real value. So now I know we just talked about a lot: subways, railways, corridors, infrastructure. And for some of you, it might feel like, okay, that's a lot to track. So let's simplify this, because you don't need to memorize project names. You don't need to know every station, every timeline, every detail. What you need is the right question. So instead of trying to remember everything, just ask this: what is making this area easier to live or easier to work in? That's it. Because if something is making life easier, if commute becomes shorter, if access becomes better, if daily routines become more convenient, people will naturally move toward that area. And when people move, demand follows. So let's bring this into real thinking. When you look at a location, ask, is it becoming connected? Is it becoming more accessible? Is it becoming more livable? Not someday, but clearly and realistically. Because here's the key: if the answer is clear, if you can confidently say, yes, this area is improving in a real usable way, that's where opportunity begins. But if your answer is a little vague, if it's based on hype or future plans with no progress, then you need to pause, because opportunity is not built on promises. It's built on real change you can see happening. So remember this: you don't need to be an expert in every project. You just need to become very good at asking the right questions. What is making this area better for real people right now and moving forward? Because when you can answer that clearly, you're no longer guessing. Now, let me give you one of the most important rules, because especially when it comes to infrastructure and corridors, this is where a lot of investors get excited, and also where a lot of mistakes happen. So here's the rule: don't invest just because you hear about a project, not because it's trending, not because it's being marketed heavily, not because someone told you this is the next best thing, but because announcements and actual opportunity are not the same thing. So instead, I want you to filter every opportunity through this. Invest when three things are true. First, it's actually being built, not just planned, not just approved, not just coming soon, but you can see progress, the real construction, real movement, real execution. Because until something is physically happening, it's still just a story. Second, people will truly use it, not just it looks impressive. Ask yourself, does this actually solve a real problem? Will people rely on it daily? Will it make commuting, living, or working easier? Because infrastructure only creates value if it changes real behavior. If people don't use it, it doesn't drive demand. Third, the price still makes sense. This is where timing comes in, because sometimes by the time everyone knows about the project, the prices have already adjusted. And now you're not early, you're late. So you have to ask, am I entering before the value is fully priced in? Or am I paying a premium for something that's already obvious? And this is the line I want you to remember: timing matters just as just as much as location, because You can be in the right place, but at the wrong time, and your returns will suffer. So let's bring this all together. Don't invest on price, don't invest on noise, don't invest on hype. Invest when there is real progress, real usability, and the pricing still gives you an advantage. Because smart investors don't just find good locations, they enter those locations at the right moment. And that's what separates opportunity from very, very expensive mistakes. Now, let's move into the next pillar, entry strategy. Because even if you get position right, and even if you understand infrastructure, you can still make the wrong move if your strategy does not match you. And this is where a lot of people get stuck. They start comparing themselves to others. They hear, "Oh, my friend bought pre-selling. Someone made money flipping. This person is buying multiple units." And then suddenly they feel like they should be doing the same thing. But here's the truth, not all investments are the same. And more importantly, not all investors are the same. Different people have different capital, timelines, risk tolerance, and goals. So, what works for someone else may not work for you. And this is where people make costly mistakes. They try to copy a strategy without understanding if it fits their situation. And when the strategy and the situation don't align, then that's when stress happens. That's when timelines feel too long. And that's when people regret their decision. So instead of asking, what are other people doing? You need to start asking, what's the right strategy for me? Because real estate is not about chasing deals. It's about building a strategy that works for your life. And this is the shift I want you to make today. Stop comparing and start aligning. Align your investments with your financial capacity, your timeline, your comfort level, and your long term goals. Because once your strategy is aligned, everything becomes clearer. You stop feeling pressured, you stop second guessing, you stop chasing every opportunity, and instead, you start making decisions with confidence. And that's what entry strategy is all about, not just how you enter the market, but how you enter the market in a way that actually works for you. Now, let's make entry strategy very simple because, again, this is where people overcomplicate things. We simplify it into three clear paths: income, growth, and long term. And I want you to think of these as not options, but as strategies based on your intention. First, income. This is where this is for the investors who want steady cash flow, more immediate usability, and a clearer connection to real demand today. You're looking for something that can be rented, occupied, or used relatively soon. So your focus here is location strength, rental demand, and sustainability. Now, second, growth. This is for the investor who is focused on appreciation, entering early, and benefiting from future development. This is where pre construction usually comes in. You're buying into a future story, an improving location, and a developing corridor. But this also requires patience and a higher tolerance for uncertainty. Because here, you're not just buying property, you're buying timing and execution. Third is long term. Now, this is for the investors who is thinking beyond short term returns. This is about legacy, land, holding for future value. You're not in a rush, you're positioning yourself for what this area could become over time. Now, here's the most important part: each one of these paths is valid. There's no best strategy. There's only the right strategy for you. And this is where I want you to be honest with yourself. What are your goals? What is your timeline? How much risk are you comfortable with? If your strategy doesn't match your situation, even a good investment can feel like a bad experience. So instead of chasing what looks exciting, choose the path that aligns with your capacity, your lifestyle, and your long term vision. Because when your strategy is aligned, you don't just invest, you invest with clarity, confidence, and purpose. So now we bring everything together because after understanding position, infrastructure, and the different entry strategies, this is where the real decisions happen. And I want you to remember this clearly. The real question is not what's the best deal, because there is no universal best deal. The real question is what fits your capital? Can you comfortably afford this without stress? What fits your timeline? Are you looking for something short term, midterm, long term? And what fits your comfort level? How much uncertainty are you willing to handle? How patient can you be? Because here's what most people don't realize: a deal can look greater on paper, but feel wrong in real life. If the payments are too heavy, if the timelines are too long, if the risk feels uncomfortable, that's not the right deal for you. And this is where many investors go wrong. They choose based on what's popular, what's being marketed, and what someone else is doing, instead of choosing based on alignment. So I want you to shift your thinking. Don't ask, what is everyone else buying? Ask, what makes sense for me based on where I am today? Because your situation is unique. Your income is different. Your goals are different. Your responsibilities are different. So your strategy should be different too. And this is the line I want you to take with you. The right strategy is the one that fits you, not your friend, not your coworker, not what you saw online, you. Because when your investment matches your life, everything becomes easier. You feel confident in your decisions, you stay consistent, you don't panic, you don't second guess. And that's when investing becomes powerful, not just financially, but mentally and emotionally as well. So as you move forward, I want you to anchor into this clarity over comparison, alignment over hype, strategy over pressure. Because at the end of the day, this is not about finding the perfect deal. It's about finding the right path for your life. And when you do that, you don't just invest, you build something that actually works long term. Now, let's talk about something very important. And honestly, this is where a lot of investors make costly mistakes: ownership. because before you think about returns, before you think about strategy, you need to be very clear on one thing. What do you actually own? And I want you to slow this down because this is not just a technical detail. This is about protecting your achievement. So in the Philippines, here's the reality: foreigners can own condominiums, but there is a condition. Foreign ownership in a condominium project cannot exceed 40% of the total units. So, yes, you can legally own a condo, but it has to fall within that structure. Now let's talk about land. Land ownership is different. Foreigners generally cannot own land directly in the Philippines, and this is where confusion happens because sometimes people assume if I can buy property, I can own everything. And that's not how it works. So this is where understanding structure becomes critical because depending on your situation, there are different ways people approach this through Filipino spouses, through corporations, through long term leases. But each of these has different legal implications. And this is why we always say, don't just look at the property, look at how it is owned. Because you can have a great location, a strong investment, good potential, but if ownership is not structured properly, you're exposed. And that's not a risk you want to take. So instead of relying on hearsay, you need to ask, is this ownership legal? Is it properly documented? Is it structured correctly for my situation? Because at the end of the day, real estate is not just about buying, it's about buying correctly. And this is why regulation and risk is a critical part of the PIER model. Because we don't just want you investing, we want you investing protected, informed, and structured the right way. Now, this is where everything becomes real because once you understand the the principles of ownership, the next layer is just as important: structure. And I want you to hear this clearly. Structure is what protects your investment, not the brochure, not the marketing, not even the location alone. It's the structure behind the deal. So when we talk about structure, we're talking about three key areas: legal structure, banking process, and documentation. Let's break that down. First, legal structure. Is the property properly titled? Is the developer compliant? Is the ownership set up correctly based on your situation? Because if the legal foundation is weak, everything else becomes a risk. Second, the banking process. How is the transaction being handled? Are you paying cash? Are you using financing? Are funds being transferred properly? Especially for international investors, this matters a lot. Because if you're dealing with currency movement, cross-border transactions, and different banking systems. Third, documentation. Do you have complete and verified documents, contracts, receipts, ownership records, developer approvals? Because if it's not properly documented, it's not fully protected. And this is where I want you to shift your mindset. These are not small details. These are not things to figure out later. This is the deal because you can have a great location, a strong demand, a beautiful project, but if the structure is weak, your investment is exposed. So instead of rushing into opportunities, slow down and ask, is this structured correctly? Is everything verified? Am I protected from the start? Because smart investors don't just look at the upside, they build a strong foundation first. And when your structure is solid, you don't just invest, you invest with security, confidence, and control. Now, let's talk about something every serious investor needs to understand: risk. Because every investment has risk. There is no such thing as a zero risk deal. The goal is not to avoid risk completely. The goal is to understand it, manage it, and control it. So let me give you a simple checklist you can always go back to. These are the four main risks you need to be aware of. Currency risk. If you are earning in US dollars and investing in Philippine peso, exchange rates matter because your returns are not just based on property value, they're also affected by currency movement. So you need to ask, if the peso strengthens or weakens, how does that impact my investment? Developer risk. Who are actually working with? Who are you working with? Do they have a track record? Have they delivered projects before? Do they deliver on time and as promised? Because especially in pre-construction, you're not buying a finished asset. You're trusting execution. Legal risk. Is the ownership clear? Is the project registered? Are all documents complete and compliant? Because if the legal side is weak, everything else becomes unstable. Another is liquidity risk. And this is the one many people overlook. If you needed to sell this property, would you be able to? Is there a real market for it? Is there demand for future buyers? Because your investment is not complete until you have a clear exit. So when you look at any opportunity, run through this checklist, not to scare you, but to protect yourself. And here's the most important principle I want you to remember: if you protect your downside, your upside takes care of itself. Because smart investors don't win by taking the biggest risk. They win by avoiding unnecessary mistakes, making calculated decisions, and protecting their capital first. So as you move forward, don't just ask, how much can I make? But instead ask, what could go wrong? And am I protected? And when you have that clarity, you don't just invest with hope, you invest with confidence, control, and peace of mind. Now, let's bring everything together because at this point, you don't just have information, you have a framework. And this is where everything becomes simple again. Because before you make any investment decisions, you don't need to overthink it. You don't need to guess. You just need to go back to the P.I.E.R model and ask yourself four clear questions. First, position. Is this the right location? Is there real demand here? Are people working here, moving here, choosing to live here? Position. If position is weak, everything else becomes harder. Second, infrastructure. What's driving value here? Is accessibility improving? Is mobility getting better? Is there real development happening around the area? Because infrastructure is what fuels growth over time. Third, entry strategy. Is this the right strategy for me? Does this match my capital, my timeline, my comfort level? Because even a good opportunity can feel like a bad decision if it doesn't align with your situation. Fourth, regulation risk. Is this safe and structured properly? Do I understand ownership? Is the documentation complete? Am I protected legally and financially? Because protecting your investment is just as important as growing it. Now, here's where it all comes together. If you can clearly answer all four, yes, this location makes sense. Yes, there's real value being driven. Yes, the strategy fits me. And yes, it's structured properly. Then you're no longer guessing. You're making a smart, informed decision. And this is the difference. Most people look at opportunities and feel uncertain. But when you have a framework like this, you move with clarity. You know what to say yes to. And more importantly, you know what to say no to. Because at the end of the day, this is not about finding more deals. It's about making better decisions. And once you can do that consistently, that's when real investing begins. And if you're thinking, I want help applying this to my own situation, that's exactly what we're here for. Now, let me give you the rule that brings everything together, because having a framework is one thing, but knowing how to apply it with discipline is what makes the difference. So here's the rule we follow. If it fails, even one part of the P.I.E.R model, it's a no, not a maybe, not a let's see, not let's make it work. It's a clear no. And I want you to really understand why this matters, because in most investing, mistakes don't happen because people just don't know better. They happen to people because they ignored one red flag, they justified one weakness, or maybe made one emotional decision. They say things like, oh, it's okay, the location's perfect. Oh, the paperwork will probably be fine. Or, the price is cheap, so maybe it's worth it. And that maybe, that's where all problems begin. So, what this rule does is it removes that gray area. It removes hesitation, it removes second guessing, it removes emotional decision making, and replacing it with something much more powerful: clarity. Now, instead of asking, do I feel good about this? You're going to ask, does this meet my standards? And when your standard is clear, your decisions become easier. You don't get distracted, you don't get pressured, you don't chase every opportunity. You become very selective, and that's where real power is. Because smart investors don't win by saying yes more often, they win by saying no more strategically. So remember this: discipline is what protects your capital. And this rule, simple as it sounds, is one of the strongest ways to build that discipline. Because at the end of the day, you don't need more opportunities. You need better decisions. And this is how you make them. All right, so let's bring everything together, because what we covered today is not just information, it's not just concepts, not ideas, it's a framework, a way of thinking, a way of evaluating, a way of making decisions. And that framework is the P.I.E.R: position, infrastructure, entry strategy, regulation, and risk. And I want you to really think about what gives you, what this gives you. It gives you clarity. Clarity of where to invest, clarity on what actually matters, clarity on what to avoid. It gives you confidence because now you're not guessing, you're not relying on opinions, you're not reacting to what other people are doing. You're making decisions based on a system. And most importantly, it gives you control over your decisions, control over your risk, control over your direction as an investor. Because without a framework, everything feels uncertain. But with the right framework, everything becomes intentional. You stop chasing deals, you stop second guessing, you stop feeling overwhelmed, and you start seeing opportunities clearly for what they really are. So as you move forward from today, I want you to remember this. You don't need to know everything. You just need to follow the right framework consistently, because success in real estate is not about it's not just a one perfect decision. It's about making good decisions over and over again. And the P.I.E.R gives you the ability to do exactly that. And when you have clarity, confidence, and control, that's when investing becomes powerful, not just financially, but for your future, your family, and your long term vision. So now the question becomes, all right, what do you do with all this? Because clarity is powerful, but only if you apply it. And that's a difference between understanding and actually moving forward. So if what we talked about today gives you clarity, and if it helped you see real estate differently, then the next step is simple. You apply it. And that's exactly what we help you do. This is what we do inside our Philippine Capital workshops and our summit. This is where we take everything you've learned today and go deeper. We bring in real opportunities, real projects, real developers, real data. So you're not just learning the framework, you're seeing how it applies in real life. And more importantly, you're able to connect directly with the people behind it. And for those who of you who want something more personal, we also offer complimentary strategy sessions. And this is where we sit down with you, look at your situation, your goal, your capital, your timeline, and help you apply the P.I.E.R model step by step to find a right path for you. So just remember, at the end of the day, you're not just making an investment, you're making a decision that impacts your future. And we're right here to help you do that the right way. We'll see you soon.